Hi everyone, in this video we have discussed about UGC NET, SET and all commerce related PSC exams topic. As we know, there are 10 units are included in the UGC NET. In this video we will discuss about the unit 4, Business Finance. Here there are 10 units are there. Then you can see the topics included in the unit 4, Business Finance. And let's start with our MCQ. The first question. The following are the important functions of financial market. Option D is the answer. Option D is source of financing, provide liquidity, reduce risk and sources of information. These all are the important functions of financial market. Question number 2. On which method does the cost of depreciation fund is calculated? Answer is option A, opportunity cost theory. Third question, the market value of the firm is the result of. Answer option D, trade-off between risk and return. Question number 4, the other name of the annual income received from the invested capital is. Answer is option D, all of these. That means net cash inflow, annual saving, cash earnings. Fifth question, the sale of financial assets is also referred to as. Option C is the answer, financing decision. Sixth, the only viable goal of financial management is. Option C is the answer, wealth maximization. The goal of wealth maximization takes into consideration. Answer is option D, that means timing of expected returns, amount of returns expected, risk related to uncertainty of returns. Next question, the investment decision should aim at investment in assets only when they are expected to earn a return greater than a minimum acceptable return is termed as. Answer is option A, hurdle rate. What is hurdle rate? It's also known as minimum acceptable rate of return from a project. Then next, which of the following is the expenditure on research and development? Answer is option B, capital expenditure. Basic objective of financial management is. Option B is the answer, maximization of shareholders' wealth. Question number 11. Dash security is known as variable income security. Answer is equity shares. Question number 12. Financial structure refers to. Option B is the answer, all the financial resources. That means short-term resources and long-term resources. Then question number 13. The cost of debt capital is calculated on the basis of. Option C is the answer, annual interest. Question number 14. Dash is the limitation of traditional approach of financial management. Answer is option D. That means It gives more emphasis on long-term problems, and it ignores allocation of resources, and it's a one-sided approach. These all are the limitations of traditional approach of financial management. Then 15th question, a risk-free security has dash variance. Option A is the answer, that 0. 0 is the variance. Okay. Then 16th question, financial decision involved with the. Option A is the answer, investment decision, financing decision and dividend decision. 17th question, factoring is a method of rising. Option C is the answer, short-term finance. Question number 18, in dividend decisions, which of the following is not very much relevant? Option A, capital market condition. Question number 19, cost of capital does not mean. Option A is the answer, cut-off rate decided by the management. Question number 20, agency cost consists of. Option D is the answer, that means it includes binding, monitoring, opportunity and structure cost. All three factors are included in agency cost. Then question number 21, finance function comprises. Option D is the answer. It includes safe custody of funds only and the expenditure of funds and opportunity and structure cost. Next, there is a question, match the following. Here you can see 4 items are given: net present value, payback, internal rate of return, accounting rate of return. Answer is option 4. Option 4, that means 4, 1, 2, 3. 4, 1, 2, 3. 4, first item 4. Net present value, it is the difference between the present value of cash inflows and present value of cash outflows. Then second, B is 1. B means payback period. 1 is the answer, number of years required to recover the original cash outlay invested in a project. Then next, C 2, internal rate of return. It is the rate of return which equates the present value of anticipated net cash flows within the initial outlay. Next, D, accounting rate of return. 3 is the answer. It is found out by dividing the average after tax profit by the average investment. Okay. Next, match the item of list 1 with the items of list 2. Net income approach for capital structure, net operating income approach for capital structure, irrelevance of capital structure for the value of firm, FRICT analysis for capital structure. Here the answer is option 2. Option 2, DCAB. DCAB. D first, David Durant. Net income approach for capital structure, David Durant. Then C, net operating income approach for capital structure, that is C, Ezra Solomon. Then next option A, Irrelevance of capital structure for the value of the firm. Modigliani, M. Miller, Modigliani, M. and Miller, M.H. Then next B. B is the answer. Robert Brenner. Next, NPV and IRR methods of investment evaluation may give divergent, accept, reject decisions on account of which of the following? The answer is 3. A and C only. A. NPV and IRR methods of investment evaluation may give divergent, accept or reject decision on account of which of the following? The option is A and C. A. Varying initial investment, and C. Disparity in the lives of the investment projects. Then 24. Next 25. Which one is not correct? Option 3 is incorrect. The discounted payback method discounts cash flows at the rate of interest. Question number 26. The optimal payout ratio for growth firm is nil and declining firm is 10%. Is established by? Option B is the answer. Walter model. Then match the following. 27th. Harry Markowitz, David Duran, Dow and M.J. Gordon. Here dividend theory, CAPM, capital structure and technical analysis. The answer is B. 2, 3, 4, 1. 2. First A 2. Harry CAPM. Then David Duran 3. Capital structure. Then C. Dow. C option 4. Technical analysis. M.J. Gordon. Dividend theory. Next 28. Which of the following project appraisal method is not based on time value of money? Answer is option A, payback method. Then 29th, in investment decision, beta is associated with, B is the answer, that is risk. Beta is associated with the risk. Then cost of equity can be measured as, option D is the answer, D1 by P plus G. Okay. T1 by cost of capital is equal to T1 by P0 plus G. Then 31. The discount rate that makes NPV equal to 0 is known as. Question. The discount rate that makes NPV equal to 0 is known as, B is the answer, internal rate of return. Next, match the following. Net present value method, average rate of return, internal rate of return, payback method. The another side, inflow after interest and tax, discounted cash flow, traditional method, decision based on cutoff rate. Match the following, and here C is the answer. 2, 1, 4, 3. 2, 1, 4, 3. Net present value method. 2. Discounted cash flow. Average rate of return. Inflow after interest and tax. Then internal rate of return. Decision based on cutoff rate. Then payback method. Traditional method. The factors affecting price earning multiples are The answer is option D, dividend payout ratio, required return and expected growth rate. The factors affecting P by E. P by E, price earning multiples are, price earning ratio multiples are, dividend payout ratio, required rate of return and expected growth rate. Which of the following is the main assumptions of Walter valuation model? Answer is option D, none of the above. You can see there. These are 5 assumptions are for Walter's model. The assumptions are all financing is done through retained earnings. There is no external funds are used, finance are used. Second assumption, the rate of return and cost of capital remain constant irrespective of the any changes in the investments, and all the earnings are either retained or distributed completely among the shareholders. The earnings per share and dividend per share remains constant. The firm has a perpetual life. These are the assumptions of Walter's model. Here you can see that the none of the above is the answer. Okay, then question number 35, the capital asset pricing model CAPM establishes the relation between risk and required rate of return. The capital asset pricing model establishes relationship between risk and required rate of return. Which of the following methods of capital budgeting is best suited for leveraged projects? Option 1 is the answer, net present value. Net present value is the best suited method for capital budgeting in the case of leveraged projects. Then 37, MMF hypothesis for capital structure is based on which of the following assumptions? The answer is 1 A, B, D. Hypothesis for capital structure is based on investors are rational and have homogeneous expectations, perfect capital market and no taxes. Question number 38. The following two statements are related to capital asset pricing model. Choose the correct code for the statements being correct or incorrect. Statement 1. Beta is a measure of securities risk relative to the risk of market portfolio. Statement 2. The value of beta measures both the systematic and unsystematic risk of a security. There are statements are given. 4 statements are given, and here option D is the correct one. D means statement 1 is correct but statement 2 is incorrect. That means statement 1, beta is a measure of securities risk relative to the risk of the market portfolio. That statement is correct and the second statement is incorrect. 39. The other name of stock dividend is bonus share. The other name of stock dividend is bonus share. Question number 40. Hypothesis for capital structure is based on the code of the following assumptions. Question number A, B, C. Option A, B, C are included in the assumption category. First, capital markets are perfect. B, firms belonging to equal risk class. And there is 10% dividend payout ratio. Hypothesis for capital structure is based on capital markets are perfect, firms belong to equal risk class, and there is 10% dividend payout ratio. Then the formula market price of shares is equal to D by K plus R by K into E minus D divided by K. Here P0 is market price of share, E is earning per share, D is dividend per share, R is rate of return, and K is cost of equity. For determining the dividend of the firm, this formula has been given by option 2 is the answer. James E. Walter. James E. Walter. Question number 42. Indicate the correct code for the following two statements of assertion A and reasoning R. Assertion. Investors in capital market now have higher inclination for investment in debentures. Reasoning. Debentures have active secondary markets now. There is some codes are given and the option 4 is the correct one. Both A and R are incorrect. That means assertion and reasoning both are incorrect. 43. Under which circumstances does the financial leverage occurs? Option A is the answer. A firm borrows fund. Under which circumstances does the financial leverage occurs? A firm borrows fund. Which of the following, for question number 44, which of the following does Walter's model related with dividend policy? Not Walter's model is related with the dividend policy. Gordon's model is related with the also dividend policy. Gordon's model is also related with the dividend policy. Question number 46. Dividend policy is very flexible, very fixed, moderate, none of these. A is the answer, very flexible. Approach is proved based on the dash process, arbitrage. Approach is proved based on dash process, arbitrage. Arbitrage means when an investor can make a profit from simultaneously buying and selling commodity in two different markets. Question number 48. According to NI approach, dash and dash are constant for all degrees of leverage. Answer, debt and cost of capital. Question number 49. A declaration of cash dividend will cause the current ratio to. Option A is the answer, decrease. A declaration of cash dividend will cause the current ratio to decrease. The last question. What does pluffing back of profit mean? Answer is returning the earnings. What does pluffing back of profit means? Returning the earnings. Okay.